Yep, no worries. We can just go ahead with it. Yeah, so basically a stock represents part ownership in a corporation. If you own a stock, you're entitled to a portion of the corporation's assets and profits. Stocks are most frequently bought on stock exchanges. So you may have heard of like the New York Stock Exchange or the NASDAQ. And so stocks are frequently traded on those exchanges. And then also units of stock are called shares.
Sorry. Yeah. So this term we're going to talk about is a bond. A bond is a loan with a specified time and a specific interest rate. They're usually denominated in thousands of dollars. So a bond is a loan made from an investor to a borrower, like you or me, typically from a corporation or the government. Bonds are typically paid back, have to be paid back before the maturity date, and they're known as fixed income instruments because the interest payments that you get are constant. They don't change. Your returns don't change the way that they can with stocks.
All right, next up, we've got an index. So an index is basically a basket of securities that represents a whole market or a submarket. So for example, the S&P 500, which you may have heard of, or the Standard & Poor's 500 index, tracks the largest 500 publicly traded companies in the US. And within that, each one is weighted according to its market capitalization or basically its size. So often indices like the S&P 500 are used by investors as benchmarks against which they'll compare their performance of their own portfolios. So one common investing strategy is called indexing. And that's where investors, instead of trying to outperform indexes, they'll just invest in an index fund, which basically tries to replicate these indexes. So this is a lower risk, more passive strategy. So for example, it's super common for investors to put money into an S&P 500 index.
So the last term that we're going to go over right now is an interest rate. And the interest rate is the amount charged for borrowing money, and it's usually expressed as a percent. So now it's time for our first strategy stop. Well, we're going to talk about simple interest and compounding interest. So simple interest is exactly what it sounds like. It's simple. With 10% interest, if you had a $100 loan, the interest would be $10 in year one, and another $10 in year two, another $10 in year three, and so on. With compounding interest, you earn interest on top of the interest. So on that same $100 loan, the first year's interest would be $100. And in the second year, there would be the same interest on the $100, but there would also be interest on that $10. So the total interest would be $12. And here's a little graph to illustrate it. I know it could be a little intimidating to look at to begin with, but it's easy when you take a look. So the principal, that blue bar in the bottom, is that $1,000 loan. With the red bar would be simple interest. So you can see it's a straight line because the interest is constant. And the green bar is compounding interest. So you can see how it goes up faster over time. And that's because of compounding interest, where you're earning the interest on your interest as well.
Okay, cool. So before I dive into this one, does anyone have any ideas about why investing is so important?
And I don't know if you checked the chat, but you can win a t-shirt for participating.
Crickets, that's okay too. All right.
Maybe you guys can repeat the question again. Sorry, what was it?
So why is investing important?
So the answers are coming in the chat now. Yeah.
Katie says investing in your future. Brian says it's a great way to build savings and make money. So yeah, that's exactly true. Both two reasons. Yeah, awesome. Okay. So basically there are two ways of making money in the world. The first is to obviously make income by working for someone else or yourself. And the second is to invest your assets so they grow their value over time. So investing is so important because it provides a more passive way to earn money. And it helps immensely when making big or significant purchases like buying a car, making a down payment on a house, and also funding your retirement. So if you don't invest your money, your money is just sitting and actually depreciating due to inflation. So setting goals, doing your research, and investing according to a plan will really change your financial health and your financial life for the better. So when you're getting started in investing, these are kind of the main steps you're going to want to hit. Number one being you need to set your goals. Number two is determine your risk tolerance. Number three is choosing a management strategy. Then you're going to want to select an account and put money into it. And then number five is you're going to allocate funds and rebalance as needed. And we'll go into each of these in more detail now. So actually, before you do any of that stuff, the first step in investing really is to save. So in order to invest money, you have to have money to invest. So one key thing that we want you to understand about investing is that you shouldn't be investing money that you're going to need in the near future. So basically, you're going to need a financial cushion to be able to fall back on just in case maybe your investment plummets. And in the case that you do need that money in the short term, you're going to want to save before you invest so that you kind of have that safety net. So does anyone have a financial goal that they want to tell us?
Hopefully you'll have a financial goal. We're just hoping you'll share it with us.
I want to buy a house.
Awesome.
It's a good goal.
Buy a boat. Oh, that's a good one.
Start saving up for retirement.
Perfect. Buy a car. Yeah, these are all great ones. Become financially independent. Perfect. Yeah, perfect. So everyone has financial goals. And in general, these goals fall into kind of three separate timelines. The first one being short-term goals. So a short-term goal falls between 1 and 5 years. So for short-term investing, you may be looking for just kind of another source of income. A short-term trading can be higher risk because returns will fluctuate more in the short term, and over the long term, they'll kind of be a bit more even and stable. So one thing to keep in mind if you're getting into short-term investing is that if your investments, or I guess if you liquidate your investments in under 1 year, you'll have to pay what's called a short-term capital gains tax, which we'll talk about more later. But basically just know that in general, on short-term investments, you have to pay taxes on any profits you're making. So it can be a bit more volatile and risky strategy. So next are medium-term goals, which fall between 6 and 10 years. And mainly these are really making those big life purchases like we said, buying a house, buying a boat, buying a car. So for big purchases like these, a good general rule of thumb is that the sooner your deadline, the more conservative you want your investment strategy to be. So say the market crashes right before you're getting ready to buy a home. You're going to want that money that you set aside to buy a home to be safe so that you can still reach your goals. Okay, finally, we have long-term goals. And this usually just means saving for retirement when it comes to investing. So you may want to open an account like a Roth IRA or a 401k, like we'll talk about more in a minute, that you'll regularly contribute to over time. For long-term goals, this is when kind of the power of compounding, you'll really see the power of compounding like Jesse mentioned earlier. And then following the rules I just talked about, generally, the closer to retirement you get, the more conservative your investment strategy becomes for the same reasons I mentioned before. And if you start investing in your retirement early, as you should, your investment strategy can be a bit riskier early on because you have more time to maybe make up for any lost ground you may run into due to market fluctuations.
Yeah, so we're actually going to talk more about that now. That's what Ethan was just describing is your risk appetite. And what your risk appetite is really how willing you are to lose your investment, because obviously if it doesn't go your way, you're going to end up losing some money. And everyone's risk appetite is going to be different. and it's going to change over time. And your risk appetite is going to determine how you invest, your investing style. So first, let's talk about high risk. So high risk investors are typically younger, like yourself and myself, because we have more time to make mistakes. So typically, most college students won't have children or mortgages or marriages that will prevent them from making their own investing decisions. And because of that, we have the ability to invest in higher risk assets like Bitcoin, which you can see in the top right of your screen. And the reason for this is because if the investment goes badly, then we have more time to recover our money without negatively impacting our long-term goals like retirement or buying a house. The second type of investor is the lower risk investor. This is typically like your parents, maybe even your grandparents. And like I was just saying, the reason that these people are going to invest with less risk is because if their investment goes badly, it could theoretically go to zero, and they'll have way less time for long-term goals like retirement. So are you active or passive? Does anybody have any idea on what active and passive investing means? Feel free to speak up or put it in the chat.
Does active refer to the short term and passive is long term?
It could be. That's partially right. Yeah, so active investors are willing to constantly check on your account. They read financial news. They know how to adjust their investment strategy according to the markets. An active investor is someone that typically maybe checks their trading account once or twice an hour. With some finance majors, no, it's typically someone that checks their accounts maybe once or twice a week, maybe a little more frequently, a little less frequently than that. Whereas passive investors, they'll look at their account every couple of weeks, every couple of months. They don't typically keep up with market news. They limit the amount of trading within their portfolio. And this is actually a more cost-effective strategy because of commissions, which we're going to talk about later. And the passive investing strategy is the typical buy and hold mentality. So now it's time for the bonus question of the night. Why shouldn't you just keep your money in a savings account in cash? This is a super important concept.
Because it's give you lower interest rate.
Yeah. Yeah, you can get a higher return from investing. Depreciation. Yeah. All good answers. Inflation, that's exactly the answer we were looking for. So because of inflation, if you keep your money in cash or even in a savings account earning a low interest rate, your money becomes less valuable over time. The interest rate you'll earn in a savings account is never as high as inflation. So that's what causes that.
All right, so next up, we're going to go over to talking about kind of what you should be investing in. I did want to just pause to ask if anybody has any questions so far. We've already covered a lot of ground here, so.
Yeah, I have a quick question. So what's the purpose then of like having a savings account? This is just for short-term place to hold your cash if you're not using it to save money?
Yeah, it's typically will be a bit more accessible than an investment account. And it's also easier to link it to a credit card, debit card accounts, withdrawing money in the more short-term sense.
Got you. Okay, thank you.
Yeah. In addition to that, a savings account is kind of like the most liquid you can have. So that's just like pure cash. So if anything comes up where you need money right there and then, that's what savings accounts are great for. And also the savings account is the lowest risk investment you can make. So if you have, a big purchase or something that you're absolutely going to need that money for, that's where you're going to want a savings account.
Cool.
All right, so carrying on. All right, so you'll hear a lot of talk about diversification, which we'll touch on more in just a minute again. But basically investing in mutual funds and ETFs makes diversification super easy. And investing in mutual funds and ETFs basically just gives you a lower risk option for investing than individual stocks. And it's also a more passive investment strategy. You usually don't need to know as much, or you don't have to be as frequently checking in on the market in order to invest in these types of securities. So now we'll go into each one and explain them a bit more. So a mutual fund is essentially, so investors can buy into shares of a fund for a mutual fund as opposed to buying shares of individual stock. You can have an active or passive fund, and mutual funds are also often professionally managed, and this comes with a price. So there are a few fees involved in investing in mutual funds. First, you can have management fees. Next, you can have front or back end loads. Loads are basically a fee that you'll pay upon making the investment, and then a back end load would be a fee you pay upon liquidating the investment. And also sometimes you'll have to pay commissions when investing in a mutual fund. One thing you should also know about mutual fund is that they're priced at market closed. So what this means is that you can't sell out of them until the market closes for the day. So in an extreme example, let's say like North Korea sent a nuclear missile to San Francisco and the market crashed. You would have to ride out that crash until the end of the day. You wouldn't be able to sell out. So that's just one thing to consider when investing in mutual funds. But the plus is that they are often actively managed, which means you'll have a professional kind of constantly reallocating the breakdown of the fund, which can, in theory, leads to better returns. Next, we have ETFs. So ETFs are similar to mutual funds, except they have intraday pricing and trades. So they work more like a stock. Basically, ETFs usually track an index or an industry. They're often cheaper than index funds, so the fees are less. They have lower expense ratios than mutual funds, and they also have no broker loads, but they sometimes do have commissions. ETFs are also generally more transparent than mutual funds, and they're available for more complicated types of investments like short sales, options, futures. And if you want to learn more about that kind of thing, we encourage you to come to our advanced investing session. But going back to that crazy example I just mentioned, in the case of an ETF, as soon as the news broke, you would be able to sell out of an ETF, which is a big plus. Yeah, and ETFs are also, just for that reason, generally more flexible than mutual funds. All right, so the second strategy stop of the night, we're going to talk about the golden rule of investing, which is diversification. So before I go into that, does anyone want to tell me like what comes to mind when you hear diversification?
Having differences.
Say that again.
Having differences between what you're investing in. Cool.
Yeah, perfect. Spreading out your risks, here it says. Investing in different companies from different industries. Brian says, yeah, that's perfect. Kind of hit the nail on the head there. So in investing, diversification is a risk management strategy that basically involves investing in a wide variety of asset classes and investments within a portfolio. So a diversified portfolio contains a wide mix of those asset types and investment vehicles. And that's really a risk reduction strategy. So this graph here looks a bit intimidating at first, but the concept behind it is pretty simple. So for every investment you're going to make, there's going to be a certain amount of risk that you're going to have to get over. But one thing that diversification helps out with is reducing the risk that you can control. So the more diversified a portfolio you have, the less kind of unnecessary risk you have in your portfolio as well. So that's one of the reasons that diversification is so powerful. So this crazy looking chart here is really just to demonstrate the concept I was just explaining, that a diversified portfolio over time is much more stable and predictable than investing in any one stock or asset class or industry. So as you can see in this dark gray going down the middle, those boxes represent a diversified portfolio, and all these other ones represent different types of assets as well. And this tracks average portfolio performance over time. So as you can see, like I said, a diversified portfolio over time has much more stable returns than some of these other investments.
Now it's time for another strategy stop. It's super important to understand the costs of investing. So there's certain costs you need to be aware of before you start investing. Lots of fees go into investing, unfortunately, and there may be a cost to start up your account. There may be a minimum amount of money you have to put into your account. Sometimes there are monthly fees for managing the account. There can also be transaction fees for when you purchase or sell shares. One other cost of investing to think about is the opportunity cost, because you're locking up your money for a long time in some cases. So trading commissions. Trading commissions are a fee charged by your broker every time that you make a trade. Let's say that you wanted to buy Apple, and Apple was trading at $100 a share. So you buy 10 shares of Apple for $1,000, and you get charged a $20 trading commission. That's going to cost you $1,020 to buy those shares of Apple. And then when you sell them, it might cost you another $20. The next term that we want to talk about is capital gains tax. And the capital gains tax is the difference between what you bought and what you sold an investment for. So with that same example, if you bought 10 shares of Apple for $1,000 and you held it for 3 years and sold it for $1,300, your capital gains tax would only be charged on that $300 of profit. It wouldn't be charged on the entire chunk that you invested with. So to illustrate this point, there are different brackets for capital gains taxes. You can see that depending on how you file your taxes, whether you're single filer, married, head of household, or filing separately, you'll pay a different rate of capital gains taxes. It also depends on your income. Sometimes it could be higher based on your income. So next we want to talk about front and back end loads. So front and back end loads are fees paid to brokers at the purchase or sale of mutual fund shares. They're pretty similar to trading commissions, but they're specific to mutual funds. And this is essentially a fee that you pay to gain access to the mutual fund, and then to get your money back in the case of a back end load. The industry is trending away from front and back end loads, but some funds do still have these. So management fees over time. Let's talk about the impact of these management fees. If you look at the blue line is earning a 4% return on $100,000 over 20 years with a 0.25% annual fee. That's not 25%, that's 0.25%. So in 20 years, your investment will go from $100,000 to $210,000. And that's a good way to illustrate the effects of compounding interest. But now if you look at the red bar, if the annual fee is increased to 0.5%, 0.5%, your portfolio will return $10,000 less. And then the green bar shows the returns of your portfolio with a 1% annual fee, and it's less than $30,000. It's less than the blue portfolio by $30,000. I know that was a lot. Does anybody have any questions? Feel free to put them in the chat or speak up.
All right.
Okay. Moving on.
Great. So now we've made it to step 4 of getting started in investing, selecting a type of account. So what are your options when it comes to types of accounts? So you have a retirement or a non-retirement account. So a retirement account can be something like a Roth IRA, Roth IRA, traditional IRA, or 401k. These are tax advantaged accounts designed for investing for retirement, and we'll break those down in just a second. For a non-retirement account, these are a taxable brokerage account, which can be more flexible. And this is what you would use for a more kind of short-term investment strategy, frequently buying and selling stocks and ETFs and things like that. So this chart I know is a lot, but this basically is breaking down for you the three main types of retirement accounts. So we have a traditional 401k, a traditional IRA, and a Roth IRA. So a few things I'll point out here are that a traditional 401k and a Roth IRA are pre-tax, which means you do not pay tax upon, or I'll rephrase that. For these types of accounts, you pay tax on your money when you take it out. For a Roth IRA, you pay tax on the money when you put it in, and this actually has a significant impact, which I'll touch on in a second. For a traditional 401k, the employer will set up this plan, or your employer would set up this plan, whereas for an IRA, you would set that account up yourself. Traditional 401ks have higher contribution limits per year compared to IRAs. And one thing that's really important to know about traditional 401ks is that employers will often offer contribution matching, which is really key. For all these types of accounts, because like I said, they're retirement accounts, they're designed to have you take out the money after you reach the age of 59 and a half. And if you withdraw the money before you hit that point, you're going to have to pay penalties and fees and taxes on the money you take out when you take it out early. All right, so when you're investing for retirement, this is going to want to be your priority in terms of investing into these types of accounts. So first, your priority should be a 401k. Like I just mentioned, oftentimes employers often offer contribution matching, which means they're basically giving you free money. So let's say every time you get your paycheck, you're contributing 5%. Sometimes your employer will contribute the same amount of money. So you're basically doubling your contribution. Second, you're going to want to contribute to a Roth IRA because, like I said, this is a tax advantaged account. So basically, the advantage of a Roth IRA is that you pay tax on the money when you put it in, like I said. So let's say you're investing in a Roth IRA right now. You'd pay tax on the money that goes in at your current income level, which when you're younger is often going to be lower, which means that you're paying less tax on the money. Whereas with the traditional IRA, you're paying tax on it when you take it out. So if your income level is higher at that point, you'll be paying a higher tax rate on the money you take out. So that's why you should be investing in a Roth IRA before a traditional IRA.
A really good question in the chat about why employers would match your contribution for a 401k. Typically, it's an incentive for workers. It's also a way to keep their company competitive for you, so that you stay there. You feel free to talk to us afterwards if you want more detailed information about that.
Yeah, like any employer benefit, that's really just an opportunity for employers to be competitive. So contribution limits from different employers will be different. So a higher contribution limit would kind of be a better benefit for you looking for a job.
Yeah, so the next step is choosing a broker. Does anybody have any idea what types of things they would look for when choosing a broker? Feel free to speak up or put it in the chat. Broker fees, account minimums, yep. Good answers. So there's a lot of things to look for when choosing a broker. The first thing to look for is the types of accounts that they offer. Next, you're going to want to look at whether they have an app or an online trading platform and how important that is to you. Or I know in the olden days you had to call your brokers to make trades. That's typically not the case anymore. Next, you want to look at the fees, trading commissions, the number of commission-free funds that they offer through that account. So not all accounts will offer the same types of ETFs, mutual funds, index funds. So it's important to know what funds your brokerage account will offer. Next, you're going to want to look for account minimums. Some accounts do have minimums, where if you only wanted to invest $100 because you don't have that much, you might not meet the minimum. Then another thing to look for is the availability of research. This is typically going to be more useful to you if you want to be a more active investor. Some brokerage accounts will offer really high quality research on specific stocks, specific funds, industries, and other types of things that could impact which broker you choose. And the last thing to pay attention to is intro offers. Some accounts will give you a certain number of days with commission-free trading. They'll give you cash bonuses. So now let's look at a couple. Some of these are all popular brokers. So if you look at E-Trade on the top, they have no trading commission for US stocks or ETFs, but they do have a $500 account minimum. So if you did only want to invest $250 to start out because you're still not super confident, then E-Trade probably isn't the right broker for you. They have 200 plus, more than 200 free ETFs and more than 4,400 transaction-free, load-free mutual funds. TD Ameritrade has no account minimum, no trading commissions, and they have a lot of US and Canadian ETFs. Fidelity is pretty similar. Merrill Edge has cash bonuses for making larger deposits. Robinhood, which is one that most people in college, most college students have heard of, they have no account minimum. It's free to trade. But you do have an option to pay for Robinhood Gold, which gives you access to margin and Robinhood's research and extended hours. Wealthsimple is the only one here that has a management fee. So they're going to charge you that management fee regardless of how much money you have in the account and how well or how poorly your investing is going. And the last one on the slide is Acorns, which is free for college students. And Acorns has a special, a unique feature where they round up purchases on linked cards. So if you paid $3.35 at Starbucks, if you spend $3.35 at Starbucks, they would round up that $65 into your Acorns account to kind of subtly force you to invest and subtly help you to invest without making a big dent in your wallet. So
Right.
Go ahead.
All right, yeah, so now I'm gonna go over some common mistakes that people make when investing. So if you remember what I mentioned earlier is that the first step in investing is to save, because you need that disposable income in order to begin investing. So in the case that you do have debt, that disposable income should be used to pay off the debt before you're investing. So you really need to be addressing the debt before you begin investing, and that'll be a much more financially responsible decision in the long term. Another mistake is having unrealistic goals. So you'll hear a lot of people say like, I'm gonna make $100,000 in the stock market this year, or having these kind of crazy out of reach goals. And that's not gonna be productive when it comes to getting started in investing. You should have kind of realistic, measurable goals before you get started. So another thing is that I want to reiterate that investing does not always have to equal the direct purchase of stocks. Like we mentioned, you can invest in things like mutual funds and ETFs, which are generally actually much easier, kind of more passive ways to get started in investing. And they're going to require less research, less diligence, and less overall knowledge of the markets. Next is lack of diversification. So we saw before why diversification is so important. And you're really going to want to focus on building a diversified portfolio as you're getting started in investing, as opposed to just dumping all your money in one or a few stocks or one industry. Another thing is you do not want to take risks to recover a loss. So let's say you own a share of Amazon and Amazon tanks. You're not going to want to pour money pour more money into risky investments in order to recoup that loss, because you may end up losing that money as well. And that's kind of an irresponsible investment strategy. And then like I said, once again, you're only going to want to use the money that you have. And that means you're only going to want to use kind of disposable income that you don't need for anything else to invest, because investing, like I said, always comes with a certain amount of risk. So you have to be prepared to lose the money that you're investing. It's unlikely, but it could happen. So if you need the money for other things, you don't want to use it to invest. So here are some key takeaways that we're going to want to wrap up with. So first is really figure out what type of investor you are. So like Jesse talked about, determine your risk appetite, determine your goals. Are your goals long-term, short-term, medium-term? Kind of consider all of the things before jumping in. Next, always think about risk versus reward. So are you investing in something that you don't know much about, in a risky investment? What's the potential for gain on the investment, and how safe is it? Those are all things you're going to want to consider. Next, determine your investing goals. Like I just touched on earlier, are you investing for retirement, or are you investing to buy a car in a few years? And those should drive your investment strategy. You're also going to want to research all your options and really do your diligence when it comes to what you're putting your money in. So don't listen to your friend who's telling you to buy this one stock you know nothing about because he says it's going to jump up 1,000%. You're really going to want to research and do your own research. That's the most important thing, and understand what you're investing in before you make the investment. And then similarly, you're going to want to ask as many questions as possible and continuously try to learn and grow as an investor as you go on. It's okay to not know everything when you get started, but you should be expanding your knowledge as you go on, and ask the important questions. So these are just a few kind of resources that we wanted to provide for you guys and outline. So places like the Wall Street Journal and Bloomberg can be great places to keep up with market news and just what's going on in the investment world. Places like Investopedia, NerdWallet, those are great places to really kind of grow your knowledge on investing in general, whether it's like looking up key terms or anything like that. Even Khan Academy has some great courses for investing and personal finance in general that can be really great and super helpful. And then of course, can't forget about Thrive. We highly recommend that you continue to come to our events and our workshops, and then also you can book a personal financial advising session with us to ask kind of more specific niche questions to yourself, and also just really take advantage of the resources we're putting out, and follow us on social media.
And if anyone has any questions, feel free to email us at nuthrive@gmail.com or message us on any of our social media platforms. We are also sponsoring or hosting an investment challenge. In this challenge, you'll start out with a hypothetical $10,000 through a risk-free stock simulator. And you can use this challenge to improve your investing knowledge and compete to win special prizes. It's starting very soon, and I just put the registration form in the chat. So definitely go register now. I know we had some really cool prizes last time, and it was a really close to see who was going to finish in the top 3. And now we are going to do a quick activity. So I'm going to get up the Kahoot. I'll share my screen really quickly. Okay, we'll give it another 20, 30 seconds if anyone else is trying to join. And then we'll start. We have 16 people now. All right, let's get started. What is a stock?
I'm sorry, it's kind of blurry. I can't really see the answers.
The red answer is an after-tax profit of a company. The blue answer is a loan repaid with interest. The yellow answer is an employee of a company. And the green answer is ownership in a company.
I
Yep,
was gonna pick that.
sorry about that. I'll be faster with
see-
reading them. if you
Okay,
still
so I
can't
think
see.
if you're having issues, it's probably your Wi-Fi would be my guess.
But that's fine. I can still read them out loud.
Okay.
Yeah, so the after-tax profit of a company is not a stock. It is used to calculate a stock. It's used in the valuation of stocks. Thomas in first place.
I could see
is
that, by the way.
not
Thank you.
an index. Okay, perfect. Ooh, this one was tricky. So the index is the S&P 500. The Russell 2000 is an index of the entire stock market. The Dow Jones is an index of 30 stocks across different industries, and the NASDAQ is a tech-based stock index. I'm not going to try to pronounce that, sorry, but you're in first place. Question 3, what is the golden rule of investing? Yep, diversification. Yep. So saving, you need to save before you can invest, but it's not the golden rule of investing. And I don't know how I would pronounce that either, but you're in first place now. Simple interest accrues more money over time than compounding interest. True or false? Yeah, so this is false. Simple interest is the same amount of interest every time. Compounding interest is when you earn interest on top of the interest you've already earned. Last question, what are some resources for investing? More than one of these answers might be correct. Yep, they're all correct, actually. I like that the most amount of people chose Thrive. Let's look at the podium. Brian is in third. Ken is in second. And in first place, I'm still not going to try to pronounce your name, sorry. An honorable mention to Diana and Thomas for getting fourth and fifth. Okay. Sorry, give me 1 second, my computer's being slow. Okay, thank you for coming to Investing Basics. Don't forget that you can book an appointment or come to our future events. You can use this link to book an appointment with our personal finance advisors. They're fantastic, super knowledgeable. They're really good with helping with budgeting, credit, investing, student loans, any other topics that you can think of. An upcoming finance bootcamp event. Next week, we have our investing advanced event at the same time. If the information in today's investing basics was super interesting, then that information is going to go even more into detail about investing. And before you leave, we would really appreciate if you could scan this QR code and fill out a brief exit survey. We'd love to know your thoughts on this presentation. We would really appreciate any and all feedback. And thank you so much for coming to Investing Basics.
I wanted to just ask before we wrap up if anybody else had any other final questions for us.
Yeah, definitely should have asked that. Feel free to unmute yourself or type it in the chat.
I do have a question. So if we want to start it with, if we want to get started with like mutual fund or ETF, I'm sorry, which resources should we go to, or how could we get started, or like just like looking at some information?
Sure, I can take that one. So some of the resources we kind of mentioned earlier are great. Just if you want to scroll back to that slide, maybe, so you can just take some of those down. But also, if you get started in investing, a lot of the apps or brokerages you'll use will have information that will be available to you. So a lot of the apps like Stash and Robinhood and those types of things will have a number of ETFs available and open to you. And then once you come into them, you'll be able to see what their focus is, what their breakdowns are like, and just more information about them. So yeah, looking into some of these resources, and then also once you do get started and you open up an account, almost all of the places we mentioned will have information available to you.
Okay. All right. Thank you.
Sure.
Any other questions? Right, if you didn't get to scan the QR code, here it is again. We really do appreciate all of your feedback, and we hope to see you at future events.
Thanks so much for coming.
Thank you all for
Good job,
coming.
guys. Appreciate it.
Thank you.
Sure.
Thank you, guys.
No
Thank
problem.
you.
Thank you.